welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have Rahul Arora, CEO of Institutional Equities at Nirmal Bang, joining in. A very good morning, Rahul. My first question coming to you over here is, uh, before we talk of the impact of COVID and what everyone should do, we just had the RBI Governor Shaktikanta Das who came and did announce a couple of measures as well with regards to where extension of moratorium goes, the cut in terms of where repo rate goes. But it does not seem that the markets are actually enthused with the announcements. What's the sense that you pick up on this front?
So here, morning, and thanks for having me on your show. I think here the problem is that the more that's being done, the market anticipates the deeper the problem is. I think, while everyone's cognizant of the problem and what the Government of India and the Reserve Bank of India is trying to do, I think the problem lies more on the demand and the supply side. So I do appreciate that the repo rate has been cut by 40 points, 40 basis points. You've spoken about extending the restructuring for the working capital loans. You've given the option of converting your interest into a term loan. But all of this is only good. People will only go out and borrow once demand kicks up again. I don't see people going out and rushing to borrow money from banks just because interest rates are getting cut. And I think the economy today is facing a very severe demand side issue. I think supply will probably take care of itself as the economy is gradually opening up. We know the airlines are opening up at 1/3 capacity on the other side of this weekend. So I think the reason the market has reacted the way it is I think it's a catch-22. It's a chicken and egg situation. The more you do, probably people think the worse it's going to get. And I think here, whatever the RBI is trying to do with the non-policy rate initiatives, I think it's just postponing the recognition of NPAs or just pushing out the stress in the banking system. And it's not sort of taking it away once and for all. And I think, if you see some of the public sector banks are hitting new 52-week lows today. And I think that's predominantly the reason why it's happening, because one is people don't have a handle on how severe this issue can be. Second, it's just a postponement or a deferment of the actual issue. And third, despite the fact that you've cut rates, you've not really done anything that is, the economy at large hasn't really taken any steps to address the demand side of the issue. So keeping a totality of all these things, and, keep in mind here, one more thing, the finance minister and the RBI governor have been, have been doing their best, but the market may also start to believe that they've pretty much done everything that they could. So incrementally, I think the expectation of any kind of stimulus, either from the RBI or the government, is probably receding. And I think that's probably the reason you're getting the market reaction you are today.
Right. But, Rahul, very interestingly, as you just spoke about the demand and supply side of it as well, where money needs to flow in. Now, what the consumers are facing as an issue right now is that there is no transmission that's happening from the banker's side. There is that hesitance from the banker's side as well to lend further. Now, if this situation removes where transmission does not really happen, do you think the situation on the NPA front, on the asset quality front, would worsen for the banks themselves probably 8 to 12 months from here on?
So I think here the two-part question sort of. So I think the transmission is more from whether you are restructuring your existing loan or taking a fresh loan. And NPA recognition is on the basis of your existing outstanding loans. I think the latter is more a function of the economy being in the lockdown for a couple of months. And after what period of time do you think your economy will actually get back to, say, 70, 80% capacity utilization? Till that doesn't happen, I think that fear is a very valid fear and it remains. As far as your point on transmission is concerned, I think if you compare it back to where rates were, say, 12 or 15 months, there has been some amount of transmission that's come in. You can argue whether there is room for more, and obviously we'll have to wait and see whether this 40 basis points gets trickled down. But like I said, Hiral, I think till the manufacturers or the suppliers of manufacturing or services don't see that demand coming back, I'm not even sure if the transmission of these rates is going to result in fresh incremental loans. So I'm not somebody who believes that credit growth, can go back to 15% just because you have these cuts coming through by the Reserve Bank of India. Because let's not forget the economy, I'm pretty sure on an aggregate basis is probably not even operating at 30-35% blended capacity utilization right now. That number probably needs to double before people start talking about capex and sort of going back and taking fresh loans. So I think there is a concern on credit growth and there is a deferment of asset quality. And I think a summation of these two things is probably what's playing itself out on the bank nifty, which has virtually collapsed from its 52 months back.
Right. So all of this taken into consideration, Rahul, if you have to compare the current scenario to say the past couple of pandemics or past couple of, I wouldn't say pandemics, but the past couple of bear markets that we've seen, if you take 2008 into consideration, if you take 2000 into consideration, or even for that matter, the time period when we saw Harshad Mehta's scam unveil. Now, if all of these bear markets, we have seen those, up moves, those bouts of up cycles that did come in, but in the end, that year was always a bear market. Are we witnessing a similar trend on the back of COVID as well?
So here the textbook definition of a bear or a bull market is a 20% price appreciation or depreciation in
Correct.
an asset class. So to that extent, we are in a multiple bear market because we started at 12,500 on the Nifty and we went down to 7.5 and we bounced back to about 9,000 right now. I think here the one important differentiator between, let's talk about this current century. You started this century with the dot-com bust that happened. As you rightly mentioned, you had the 2008 crisis. You've had a few intermittent crises between then and demonetization, but I think the most significant one between 2008 and the current pandemic was probably the demon time that you had. I think in all these cases, Hiral, I don't think the economy went into a cold storage that you are seeing right now.
Mm,
And the problem is that you don't know how long this reset can take. I think any discussion you, me, or anyone in the country today is having is at best a guesstimate and trying to make sense of what the evidence that's available. And I don't think any of us really has all the answers. I think the reason this time is different from anything else, and I've heard comparisons and I've tried to do some reading comparing it to the Great Depression of 1929, 1930,
correct.
is that really none of this had the entire economy reset. And the reason that 3 lakh crores was given out by the finance minister to the MSMEs also is a recognition of the fact that these guys are actually on the verge of going under. Some of them may never restart their operations in the way it was, till just a couple of months back. So I think we need to acknowledge the fact that this is unlike anything I have seen in my
Mm,
lifetime. And even though we may have a medical solution at some point this year, and I sure hope we do, I don't think that's going to reset the damage in a hurry. So this could actually land up, the ghost of what we've seen in the last 2 months can actually land up lingering for a year or two
mm.
before things essentially get back to normal.
Right. So, Rahul, right now, the kind of lows that we already hit so far in terms of Nifty, if there is a second wave, we hope that there is not, but at least the doctors are saying that yes, probably you could see a second wave. We don't know how severe it will be in the month of September or October. Then, are there chances of we breaking that 7,500 level as well on the Nifty?
Here, I wish you hadn't asked me that question because it's not something I really want to answer. Because as they say in the casinos, if you're playing blackjack with the dealer,
Hmm,
he
hmm.
deals you a couple of blackjacks, all bets are off. I mean, if you're going to get a second wave of this, I don't know. And if you don't have a vaccine by then I think all market levels are purely academic discussions. You can't rule out. I mean, even when this entire issue started, we were at 12,500 on the Nifty. I don't think too many people put their money on a 7,500 Nifty either. I mean, you just fell 5,000 points as effortlessly as you did, and you've only recovered about 1,000, 1,500 points from there. So, if for whatever reason you get a second round of this, and I sure as hell hope you don't, but you know, it's a fallacy to put a number there. I think all bets are off. And at that point, I don't think the market indicators will be, or market levels will be more important. I think, today we're talking about livelihoods and businesses sustaining and the economic sort of condition of India. I shudder to think what it'll be like if this is repeated in the winter of 2020. So let's not get there for the moment. I think, let's try and assume the worst is behind us and look forward as we move towards the monsoons and Diwali. I think let's hope things get better
Better.
between now and then.
Right. So right now, if you have to look at markets, and even in terms of valuations, if you have to look at Nifty, Rahul, we're still not at the bottom. Because in terms of the bear markets, we've always seen a PE multiple, say, of around 10 times. Right now, we're still in that 14 to 16 times kind of range. Do you think there is a possibility that we could reach those levels in terms of valuations? Because right now, investors really don't know what kind of multiples that people need to look at. Valuations have gone completely haywire. So, what is it that the markets are watching out for? Do you think that the markets are right now worried, say, if you have to look at corporates, that what could be the cost of restarting the companies right now? Because that is one of the major, hurdles the capacity utilizations are below 50%. And clearly, there is a swing that's happening between hope and fear.
So I think here, let me answer this in a way that you probably are not expecting me to answer it. So price to earnings essentially is in the denominator, you have the earnings. At this point, I don't think anyone knows what the earnings
Earnings.
for FY21 is going to look like, because quarter one is a virtual washout.
Absolutely.
So I mean, if you were to just very simplistically assume that quarter one is a 100% washout, quarter two is probably a 50% washout, quarter three is say getting back to say a 25% washout, and by Q4 you're back to normal. I think if you sort of assume that gradual recovery that you take, FY21, I think on earnings is a washout. So I don't think there's any point looking at a price to earnings multiple on FY21. I think what's probably more pertinent to do is that the base effect of FY21 is going to be so favorable if things move, in the positive direction for FY22, that it's probably best to look at valuations on FY22. And the way I would advise your viewers and investors to look at this is, try and make an assessment of companies whose profitability in FY22 will be similar to, if not exactly equal to, what they did in FY20. So I'm saying you ignore FY21 as a bucket as a whole. So if your companies that you have in your portfolio or you want to buy are able to get to within 75 to 100% of their FY20 profitability by FY22, don't wait for 7,500 or 8,000 again. Go out and buy those companies even today is my advice. So I think that's probably a more academic way of looking at it, but I think it's a slightly more practical and a slightly more thought out way of looking at it, rather than trying to predict what Q1 FY21 or Q2 or Q3 will look like. I think those are virtually irrelevant as we speak right now. It also plays to the thesis that stock market should be a long-term investment option. So anyone entering the markets right now, I would urge them to at least have a 24-month horizon. And I think the kind of monies you can make, if you follow what I just told you, would be disproportionately on the higher side.
I mean, this is a very important and a well said point that you've marked out, Rahul. And with this, because usually what happens is when markets are in a crisis situation, there is panic, and the common response of investors is either they exit their investments, or they are, when they are near the bottom. So if you have to look at the corrections that we are seeing right now, how should an investor use it as an opportunity to build their portfolio for healthy and steady returns? I mean, what sectors would you bet on?
So, Hiral, I think the first thing people need to know is the very old adage that you can't catch the bottom and you can't catch the top. I don't think even people who've been in the market for 20, 30 years have that expertise to catch either the bottom or the top. I think what's safe to assume is that you've had a very healthy correction from 12,500 on the Nifty down to about 9,000 where we currently sit. I think it's not a bad place to enter. You have to look at it from a risk reward standpoint. So if I'm entering a stock today and I run the risk of that stock, say, falling 15, 20% from here, but if I'm comfortable that that stock from that fall will probably give me 50, 60%, I'm still better off buying that stock today rather than trying to be brave and waiting to catch the 100% of the move. So I think that's the first thing people need to realize. The second, Hiral, is I think in terms of sectors that you asked, I think you need to break it up into three different buckets. One is, who are the existing beneficiaries as this pandemic is playing out?
Okay.
The second is, who would be the beneficiaries for the remainder of this calendar year? And the third is, what will happen in calendar year 2021? I think the people who are being beneficiaries right now as we speak, obviously the no-brainer is pharmaceuticals. And I think you've seen them in the last 3 months, depending on which pharma name you pick up, the stocks are up between 50 to 150%.
Absolutely.
I think the other part that's continuing to do well as we speak is consumer staples, because people have cut down completely on discretionary and they're basically only focusing on the essentials. And I think you will see that reflected in the company's results like Indiva, ITC, Dabur, Marico. When they declare their Q1 results compared to what they did in Q4, you will start seeing that trend of things getting better. So I think consumer staples and pharma are two sectors that are doing well right now. And I think this entire concept of work from home has taken on in such a big way. And there's so much for the IT companies to do by way of systems, processes, and digital. I think that's the third leg that I would look at. So I think these three sectors currently would be the existing beneficiaries.
Right.
I think as you get closer to Diwali, consumer discretionary probably makes a comeback. And I think that's something that you need to look at very closely. It's
Hmm.
not a bad time to start buying. And I think if you are having that 2-year view I spoke about and the economy does come back on track, say starting calendar 2021, you can start looking at cement and infrastructure deals.
Right. Rahul, one sector I want to ask you about is with regards to where the auto space goes, because everyone's talking about, I mean, the sector was already into doldrums in terms of 2019 itself. The hopes with regards to recovery were not really seen, and this has come in as a spoil sport. But now, when you think about it, and if you have to play a devil's advocate on the positive side, do you think there could be demand picking up on the auto side of it as well, especially if you have to look at the entry level segments in the two-wheeler space, if you have to look at, not the luxury segment in four-wheelers because entry level, because right now there is uncertainty as to how many people are going to travel by train, how many people are going to use public transport. With regards to cab services, even the other public transport services, no one really wants to risk it. So, do you think this could be a time where you could bottom fish with regards to auto companies, not really be scared about it, and probably these will be ones who could be recovering? I'm saying from the entry level, maybe yes, your margin profiles and all will not be that great, but you could see good turnovers.
It's amazing what 3 months in the life of a stock market can do, Hiral. Just 3 months back, I mean, of course, this argument's been there for a while, but up to 3 months back, one of the biggest theses is not to buy into auto stocks was shared mobility. And I think now people are saying, look at auto stocks because shared mobility will not pick up in a material way.
Correct.
And that's what 3 months of a pandemic can do for you. So I think the way people are approaching this sector has changed dramatically. Uh, Look, I'm not in that camp that believes shared mobility is going to be dead forever,
Hmm.
right? So obviously, once you have a vaccine that comes out or a medical solution, I think shared mobility has a place in society, and I think there will be consumers for it. But yes, I think for the immediate future, over the next 1.5 years, you're right. I think people are going to be apprehensive about traveling in any kind of shared mobility if they have access to their personal mobility or someone in their family or friends or neighbors who could probably assist them with that. So I think to that extent, that argument 3 months back that shared mobility is going to sort of take away the volume growth of the auto sector. I think that's sort of on the back burner for now. So that argument now goes in favor of the auto sector. The other important part here is there have been so many regulatory changes that we have seen in the auto sector and so many cost increases, whether it's BS6, insurance, and other mandatory hikes that you've had to take, that the price of owning a two-wheeler or a four-wheeler has gone up anywhere between 10 to 20% over the last 1 year or so. I think what you're probably going to see now is that when people come in to consume the auto sector is down trading. And I think when you do that down trading, it doesn't matter because your volume growth still happens. You may take a hit on realization and margins, but I think auto companies will be fine with that. So if I was somebody who say wanted to buy a Royal Enfield or a higher CC Bajaj auto bike, I probably go to a lower CC Bajaj auto bike or I maybe come to a Hero. If I wanted to buy a Ciaz, I probably go to say one step lower to a in the Maruti range that I have, but my volume growth still happens. So I think the sector was beaten back, battered and bruised out of shape. I think there is a case to be made. Valuations are reasonably mouth-watering. I think if you look at as a case in point, if you look at Hero MotoCorp's share price in the last maybe 2 months, the stock's up 60%. So it's just telling you how people's mindsets are changing. Definitely bottom fish. I think a lot of these companies are cash rich. They are not too leveraged. You can stick with the industry leaders, whether it's a Maruti or a Hero or a Bajaj Auto. I think here, if you have a good monsoon as is being predicted, you may, and the scrappage policy comes through, you may actually get at some point towards the back end of this year even a revival in the commercial vehicle side of the business and tractors. So it's
Correct.
an attractive sector. I would definitely look at parking some monies there.
Right. So that's with regards to where auto goes. Now, if you have to make a selection between PSU banks and the public sector banks, where would your bets be?
Hiral, if you will, I wouldn't touch banks at all right now. I think most institutional investors also are going to be underweight banks for the rest of the year. See, corporate NPS was anyway a big issue. I think with the MSME issue that's facing us, that I don't think that's going to go away in a hurry, even though you've got relaxations in the IBC and the moratoriums provided by the Reserve Bank of India. So I think that corporate NPAs are here to stay. I think the big problem here is going to be the retail NPAs. I think for people who've lost their jobs or have got salary resets, I think there's going to be an issue in terms of retail NPAs, and I think some of the consumer financing stocks the way they've halved or even less than halved, I think there is the story to be told there. If you must play the banking sector, I would urge you to play just the leaders on the private sector side. Maybe a Kotak or an HDFC. But I think as an aggregate sector, I would probably be underweight. I think, it's not a bad time to start looking at asset management and insurance companies. We have a couple of asset management companies listed in India. We have 4 life insurance companies. We do have, a general insurance company also listed. ICICI Lombard is listed. So I think there is a lot of life in the BFSI sector beyond the lenders, and I think there could be an opportunity there. I know gold is the new buzzword in town, and gold is doing really well. You could probably look at gold finance companies, maybe something like a Muthoot or a Manappuram. So I think in the entire BFSI basket, I think I would probably focus more on the non-lenders as opposed to the lenders. But if you had to be in the lenders, more private sector, and in the leaders, the couple of names that I mentioned.
Right. That's an interesting one on the banking side. In fact, Rahul, there are a couple of questions pouring in. An attendee wants your view on Tata Motors, Bank of Baroda, SBI. I think you well covered in this answer, but something on Tata Motors if you have a view for the next 24 months.
So here, like I said, Tata Motors, of course, is unique because it's a very big global play also with Jaguar and Land Rover, and I think you have to take a very big call in Europe and China for that. I think sitting in India today, we are not able to take that call in its entirety. I think if China and the European Union rebound in a material way, specifically the United Kingdom, I think Tata Motors could have a good play. I think if you have the scrappage policy come through, Tata Motors will again be one of the beneficiaries. So I think Tata Motors, Hiral, for a lot of investors, particularly on the institutional side over the last couple of years, if not more, has been more a JLR story, to a lesser extent, maybe the heavy commercial vehicles. And I think lastly, they probably play the passenger vehicles. So I don't think Tata Motors has ever been played from an Indian passenger vehicles perspective. It's more been JLR, the heavy commercial vehicles, and then passenger vehicles. I think you could get other better options in the sector. If you are holding on to Tata Motors, I mean, I don't know where the viewer has bought the price, but if he's lost a lot of money, sometimes the temptation is to sit in the stock and try to recoup those losses if the market goes up. But I think there are other better opportunities in the sector apart from Tata Motors. You could shift it. You don't have to be in the Tata Motors kind of segment. For example, I mean, if you're paying Tata Motors for the heavy commercial vehicles or things like that, why not an Ashok Leyland? Right? If you want to play for passenger cars, why not a Maruti? And as we were discussing earlier, if you go to rural India and you talk about downtrading and things like that, why not two-wheelers? Why not a Bajaj Auto or a Hero? So I'm not particularly sanguine about Tata Motors because it's a very global play and I don't have all the variables at my disposal right now. It's a very big call in two very large economies. But I think I've given some other options to the viewer as opposed to Tata Motors what he could do.
Right, so that's with regards to where the auto space goes. Another question coming in from Bhavna Bhargav is that the 3 sectors which you're recommending, could you specify any stocks of those sectors from a 1-year horizon perspective?
You would mean within consumer, pharma, and IT?
Absolutely.
So, Hiral, I think if you're looking at consumer staples right now, obviously the valuations of HUL and Nestle are very high. If you're holding them, there is no reason to sell them, is the point I'd make. But buying them at this price, I'd say maybe a Hindustan Lever may not be a bad buy even at this price. I think if you look down the market cap chain, I would probably look at a name like, say, Britannia or a Dabur. I think those would be a couple of names. And like I told you, Hiral, I think as we go along, I'm expecting discretionary to make a play. To come back, I'd look at the QSR space, the quick service restaurants. So either a McDonald's or a Domino's may not be a bad idea. On the pharmaceutical side, I think as a house at Nirmal Institutional Equities, we're very bullish on Sun Pharma. I think that's a name where I think we're a little more aggressive than the rest of the street in terms of our price targets and our earnings expectations. I think Cipla is another name that we like, and Natco in the mid-cap space is another name that we have been recommending. On the IT space here, actually underweight, but I think you've seen a relative outperformance. So I think if you must be in the IT space, I'd say probably just stick with the top 3, which is Infosys, TCS, and HCL Technologies. I wouldn't flirt with the mid-cap names right now in IT because I'm not sure about what the outlook on the US economy is over a longer period of time. But I think in these three sectors, these are some of the names that I can think of the bat.
Those are good recommendations. And IT, I think everyone's of the opinion to stay away from the mid cap guys right now. Rahul, any view with regards to RIL? Because that question keeps arising a couple of times, especially whether one should actually, subscribe to the rights issue or not. And the quantum of investments that are pouring in with regards to Geo, it's unbelievable at this hour.
Hasn't someone been productive working from home here? I think almost 1.5 lakh crores plus in the bag since work from home started
Yeah,
for Reliance Jio, and as of this morning as well, KKR pouring in about 11 to
absolutely.
12,000 crores. So obviously here I think the management has made a call a few years back that they want to deleverage or diversify away from the traditional oil and gas business and become more from becoming a B2B player to becoming a B2C player. I think whatever initiatives they have taken even in the run up to Geo, whether it was retail or jewelry, of course, Geo is now at the forefront of it all. I think over a period of time, Hiral, I think the bulk of the profitability and the EBITDA is going to come from the non-oil and gas space. So I know RIL today is some of the parts valuation, and I think Hiral, if I can just combine RIL along with Pharma to make one point. Both these pockets, if you will, are coming out of years of underperformance and
Correct.
years of under ownership.
Yeah.
These are very important metrics when you look at the market. And the reason the pharma stocks have reacted the way they have, and Reliance and Bharti have reacted the way they have, your underperformance and under ownership actually plays a very big role to that effect. So sometimes what happens at times like this, Hiral, is that you may not really see a material earnings expansion, but you may actually see a price to the PE multiple expansion happening much faster than the actual
Correct.
underlying earnings growth. And that's what takes these stocks much higher. So I know these stocks have done really well, whether it's Reliance, Bharti or Pharma. But the reason I would still remain sanguine on them is I think investors will probably still look at these names because of these two very important technical reasons that I gave you. Also, Hiral, I think one very important point, and this is probably sounding like a tutorial, but I think it's very important to understand, is that if my advice is to be followed on being underweight banks, and banks is essentially the mother of all sectors in the
Correct.
index, which is 40%. So if you go, say, even 3 to 400 basis points underweight that, you have to then park your money somewhere else.
Yeah.
So it is also a function of the liquidity that's going to come into these sectors. So I think, there are some technical auto corrections that are happening, and there are obviously fundamental reasons. In the case of Reliance, there is genuine deleveraging of the balance sheet also that is taking place. So I think there is a case to be made if you're a shareholder of Reliance to remain there. If you've not bought it, I'm still one of those people who believes you can buy and still make some money in the stock.
Right. That's a good point on that one. And Rahul, with regards to pharma as well, with a couple of conversations that I've had, the bigger story with pharma now lies with regards to what's happening on the API side of business. Because the kind of initiatives, the kind of pharma parks that the government is also looking at right now, the next 5 years are going to be with the API players in terms of pharma in India. Do you agree with something like this? Because they again want to make India self-reliant, at least on the API front, which probably we were before 2008, 2007.
It's a very good point you make, Hiral. It's a very valid point as well. And, good luck to these companies. And I think there's enough and more money to be made there. It's not just API, Hiral. I think if you look at the branded generic space in the United States, I think there are billions and billions of drugs that are going off patent in the next 2 or 3 years. And, all our companies that have a presence there, and not just the companies I named. I mean, there are enough and more companies, who are doing good work. Remember when this entire COVID rally started, it started with Ipca Laboratories, and the fact that they had hydroxychloroquine at their disposal. And, Aurobindo has been doing great things in the United States. And there are so many of these other companies, not just on the API side, but even on the global generic space, even on the branded generic side. So I think there are various verticals, Hiral, and some of these companies that I've addressed, some may be stronger in one vertical, some may be stronger in another vertical, but I'm pretty much confident on Indian pharma over the next 5 years, the kind of opportunities that are going to open up. You are going to see a PE re-rating happen in these stocks. We, as a sell side house, are constrained by valuing stocks on a 1 year forward basis. Your viewers are not constrained to buy it with a 1 year forward. So I think if you take a 5 year view on Indian pharma,
Mm,
it's just going to open up in ways that I don't think we are able to put our fingers onto right now. And the kind of money that can be made in this sector
mm,
is kind
mm.
of obscene. I mean, just look at what Hindustan Lever has done in the last 5 years.
Correct.
I don't see why a Sun Pharma or a Dr. Reddy's or an Aurobindo or a Cipla or anyone else from the mid-cap universe cannot replicate what a Hindustan Lever or a Nestle have done over the last 5 years.
Absolutely, Rahul. Well put up as well. And I think this is the time where investors need to actually convert this crisis into an opportunity from a long-term perspective, right?
Absolutely. They say the best opportunities are in times of adversity. So, I just hope people have kept a clean and open and healthy mind while they've been home for the last 2.5 months. It's very easy to just look at the news flow and the market levels and get bogged down. But, Hiral, we're a country that moves forward. We're an optimistic country. I mean, there
Yes.
is so much bad that's happened in my livelihood. You had the 1984 sea
Mm,
crisis, you had
mm.
the 93 bomb blast, you had the 2008 attacks on our country, you had floods, you had famine. We just find a way to move forward. And, if you're not going to take care of your investments when it's the right time to do so, uh, you know, opportunity doesn't keep knocking. I mean, you don't get a 5,000 50 point fall like this every time. So there is no point getting too greedy on the way up. There's no point
Correct.
getting too fearful on the way down. Just keep a balanced mind. The Bhagavad Gita says, keep a sthir buddhi. Just follow the middle
Correct.
path. Keep both emotions at
That's,
a bay.
yeah.
And I think this is not a rule. There is a science to it. But if you just apply basic common sense, I think there's a lot of money to be made.
Absolutely, a lot of money to be made. Thank you, Rahul. Thank you. It was an interesting conversation that we've had. Great insights. I hope attendees have picked up as well, and sectors and stocks that one should be looking at from a longer term perspective. We will come back to you once where the markets move in a couple of days to understand what should be the strategy, or is there a shift happening on that front. But thank you very much for joining us.
Thank you for having me here.